Hey, good morning, everyone. Marty Missouri here, Tuesday, September 10th, 2019, with your pre-market update. S&P 500 future chart, the daily chart on your screen. A couple of days ago, I mentioned that this line right here would be unsustainable, and we'll either see the market, move out sideways from that and give us a more normal-looking trajectory going higher, or of course, always the possibility of a breakdown below. And I said yesterday that my short-term expectations are probably better than 50-50, that we see new all-time highs before we ultimately come down and correct in potentially dramatic fashion, which remains my base case ultimately, and that's based on the longer-term technicals and my concerns relative to the macroeconomic underpinnings and the or the economic fundamentals, if you will, that we see underneath the market. As I also keep saying, this market can go in either direction, and this market is trading very much on emotion, very much on policymaker commentary, tweets, and so forth, and hypersensitive to revelations or to news items or commentary around the negotiations with China. And, we're getting mixed signals right now. As it stands, there will be talks both in mid-September at a lower level and then very high-level talks in October. And there is some optimism clearly within the market that something good's going to come of those talks. When you dig a little deeper and you look at what both sides are demanding, the odds of something substantial and something meaningful in the relatively near future look very low, but of course that remains to be seen. Right now, there's a lot of call it market manipulation, given the political season and so on, and so I'll just kind of leave that one there. I'm going to finish up with the hourly chart again, but before I get there, I do want to touch on kind of what was yesterday's big news in the financial media, and that was a big spike in the consumer credit numbers. Yesterday we got the consumer credit data, and consumers ramped up their credit by a whopping 23.3 billion in the month of July. And frankly, the bulk of that was credit card debt. Now, a lot of people cringe at that because that, that's too reminiscent of bubbles past and so on. Economists in the near term would tell you that's good news. So would tell you that speaks to optimism. It speaks to what we've been seeing of late in terms of strong retail sales, and it speaks to, good things going forward. Of course, it doesn't speak well of ultimately household wealth, and debt is not a problem as long as it's used for productive means. If indeed consumers are, in the mood to really get busy and start using those credit card balances that they've been pretty disciplined since this last recession on, then ultimately when the next recession comes, and it's a when, it's not an if we have a highly leveraged consumer, we have issues. So I would say definitely not a near-term problem, but longer term, a potentially serious problem if indeed this continues and consumers begin enjoying too much of a good thing. In terms of overall consumer debt, a lot of the bears are really pointing to this. You can see that's just a massive number that just keeps going up and up. Again, looking at the monthly increase until recently, that wasn't that concerning. Looking at the year-over-year increase at 5.2% isn't that concerning. As a percent of GDP, that's actually a very positive look. And debt to disposable income ratio looks good as well, but that data there is 4 months old. We should be getting updates on that pretty soon. But the most current data is this data here, and that suggests, once again, consumers are enjoying their credit cards. I remember yesterday my chart of the day was on the big surge in folks who have more than one job. So a real pessimist might say, well, they're having to ramp up their credit cards to stay afloat. That's not the case, or we'd be seeing that in the consumer confidence numbers and the retail sales numbers and so forth. So that's not the case. This is bullishness on a near-term basis as it relates to the consumer. Right now, though, when we're talking the use of debt and let's say the use of capital, Looking at debt first, this is the stuff that concerns me. When I keep talking about cracks under the surface, really today talking about the corporate debt market, and frankly, I'm really zeroing in right here. The percent of existing corporate debt out there that falls in the triple B tranche. And the triple B is the last rating of investment grade. You can see that it's nearly 50%. Why is that a problem? Why is that such an issue? Well, what happens in recessions, of course, business slows, revenue slows, and so forth. And when you have companies out there that are issuing triple B debt, well, there's something going on with their balance sheet that forces that rating and forces them to pay a higher yield. If indeed their revenue begins to fall, and if indeed that credit rating drops below triple B, there is a mountain of money managed within, for example, pension funds that can only hold investment quality debt. And they hold a raft of it at triple B because that gives them the yield that they need. That gets downgraded below triple B minus in a recession, which no doubt a chunk of it will. Those pension funds, for example, have to sell immediately. And when they sell, that is going to be very problematic for those companies, for the credit markets, and so forth. And if it happens in mass, I can tell you, folks, it's going to smell really bad. And to a lot of people, it's going to smell like 2008. And 2008 is still hardwired into the psyches of investors and consumers and so forth. And that's the sort of thing that could morph into a precipitous, huge bear market for stocks. And I mentioned use of capital. Apologize, this looks a little blurry to me, but corporate profits used to go mainly to CapEx. Okay, CapEx is what you want. That's capital expenditures, that's expansion and so forth. That's businesses using their profits to actually expand their businesses. We also look at to the extent companies are issuing debt to expand their businesses, and that hasn't been the case to the extent that I like. A lot of that debt that has been issued has been used to pay dividends and buy back shares and refinance old higher interest debt, which I like, but you do want capital getting deployed. And that's one of the things that has not been happening of late, and that concerns us as well. And that hits the macro pretty hard. As the headline reads, corporate profits used to go mainly to CapEx. Today, they're mainly going to dividends and buybacks. That does inject capital into the economy, right? You're paying dividends and you're buying back shares. So that's capital. It's going back into the hands of investors to do something with. But it's not companies confident enough to make big investments and expand, creating jobs, creating productivity, profitability, and that sort of thing. Again, late cycle stuff that maintains share values, maintains earnings per share, and stuff that as an investor I've never really argued with. But you got to look at it in the context of the macro, of the big picture, of the economy, if you will. And what does it ultimately portend? More, better, faster growth going forward? Or maybe the signs that we're nearing the end of the longest expansion in the history of all expansions. If that's the case, and we're going to have to deal, with this kind of a corporate debt picture, we better know what we're doing, and we better be cautious when we need to be cautious. Lastly, just to close up here, once again, looking at the hourly charts, we broke out of our range here. Remember when we first broke out, I did say that it would be normal to see a back test of this level. In fact, it would be very normal, and it would be very bullish if we come back test that what was once resistance. If it becomes support and we bounce out of that, then we get to my near-term expectation of new all-time highs and so forth, and we might do that with some momentum. If, however, we break down in here below that, that would be a very negative sign. There's nothing worse than a failed bullish breakout. If that happens, we could see it get really, really ugly in a hurry if we drop back down into this range. Again, I think there's a real short-term case based on coming news about European Central Bank and U.S. Central Bank stimulus, although if they disappoint, we could be back down here in a hurry. And then what has been an optimistic tone on trade. Those are the kinds of things that could give this market a sentimental push. As I did say the other day, though, I think that a good amount of the short interest that was sitting up here may have already covered. So we may not have a lot more short covering. We could. There's a level right up here. I could see some short sitting. But I suspect there's not as much of that here as there was here. I think there was a notable amount in here that covered, that got us this push right here. And when people are buying in here and we get all these bulls sucked into this market and they have stop losses perhaps below a level right here, they come in, we break through that level, all those stops hit, and then you get a precipitous waterfall kind of selling below for a while, which could build some momentum as well. So as I said yesterday in the close, one thing we can expect for sure is lots of volatility going forward. And I think in both directions, we here at PWA are going to keep our focus on the longer term. When we see breakdowns in the technicals, our own macro data showing increased signs of recession, and then again, you look underneath and you see the potential for some really big bombs to go off. And I do want to emphasize potential. Right now, we think it is very prudent to tread cautiously while the conditions are as I've been describing. Better to protect against the big downside than worry about participating in what could be pretty limited upside if you look at current levels. I'll leave it there. Thank you, folks, as always, for watching and listening, and talk to you again soon. Bye-bye.